Stockhand podcast. My name is Irene. Each episode will bring to you anything about the market from A to Z. First of all, I would like to apologize for not being able to update you guys on the market news in the past few weeks. The reason being that I was very busy preparing for derivative licensing exam. And guess what? My result just released few days ago and yay, I have passed! So yes, you heard it right. We'll be offering futures, options, and even CFD as an alternative investment products to you on top of the usual stocks or equities. While some of you may be even more skillful in this, but don't worry for those of you who may not be familiar with derivatives, we'll definitely prepare more contents or materials to explain to you in the upcoming weeks. So stay tuned. Well, it is already approaching the end of April, and we expect the market to continue being in a turbulent mood as many big companies are pending to release their QRs this week. Last Friday, we saw Dow Jones suffered its worst one-day loss since the pandemic by falling as much as 981 points or 2.8%, and S&P 500 had its worst day since March, and Nasdaq declined 2.6%. Friday's action actually followed a dramatic reversal Thursday after the speech by Chairman Jerome Powell that actually dented the market sentiment. Powell said during an IMF panel that taming inflation is absolutely essential and a 50 basis point hike is on the table for May. So they will be meeting again next week on 3rd and 4th of May to decide on the interest rate hike as well as balance sheet reduction. So I believe that the market will continue to be very volatile leading to the dates as all eyes on federal actions now moving forward in countering inflation. Last week itself, we saw how brutal the price drop of Netflix after its disappointing results, and when the market was hopeful that Tesla may offer some form of support after reporting another excellent earnings, unfortunately, the Federal just wouldn't allow the market to advance further and instantly kills the market after the speech by Powell. And next week will mark another big week for earnings with more than 500 companies reporting, including the large caps technology giants. So it is a very important week ahead, seriously, because if even these giants are not doing well, then the market may drop further and break the previous low that we saw in March, and it will definitely not look good in our very own market as well. So coming Tuesday, we have Alphabet, Microsoft, and Visa earnings will be in focus, and Meta, Qualcomm, and PayPal will be due on Wednesday. On Thursday itself, we have the hottest debated stock recently, Twitter, to release earnings, together with Apple, Amazon, Roku, and Intel. While Friday, we'll have two oil majors, XOM and CVX, to report their earnings. So you can see this week is definitely another week for a roller coaster ride. We have seen how brutal the market will be if the results fail to meet market expectation. But even if the earning is in line with the expected results, it is all very much depending on what is written in the report itself for investors to gauge their performance for the next few quarters. One main reason that last week's sell-off was terrible was because many earnings announcements have included cautionary remarks about future sales growth amid high inflation that sort of dampened the market sentiment further. We have also read some interesting facts about the relevance of stock market performance in relation to the US midterm elections. So this is a midterm election year after all, and numbers going back more than a century ago show that the second year has generally been the weakest for the stock market in a president's term. This rough patterns isn't a constant throughout history, but it has occurred quite frequently in presidencies going back to 1900. After a weak stretch in the midterm year, the stock market has usually rallied. So, will the history repeat? Will the stock market actually rally somewhere probably in the fourth quarter, right before the midterm elections? Well, we do not know. The only thing that we can do is continue to watch out on our risk appetite and cash ratio accordingly and never going against a market trend. But analysts such as those from JP Morgan believe that the stock market may be poised for a near-term rally after investors turn too bearish on stocks. While they recommended to reduce exposure on equities, they also remain constructive on equities and think that a near-term rally is likely if there is a moderation in inflation. They believe that if those imbalances work themselves out, some expected interest rate hikes by the Fed could get priced out of the curve, especially as we get closer to midterm elections, hinting that interest rate hikes may be on pause during the late summer and early fall just before the event. They recommend investors to position their portfolio for upside by buying both growth and value stocks, which according to the analysts that some of those growth stocks, which they usually refer to tech stocks, are now so cheap that they have become value stocks. Recently, we have also saw the US equity funds face big outflows as concern continue over economic growth, rising yields, and prospect of a more aggressive monetary policy. In fact, the outflow from broader US equities fund was the biggest since December last year, and many believe that it is just getting started as the Fed ramps up its hawkish stance. The same has occurred in the global bond markets where bond sell-off accelerated on expectations of more aggressive Fed tightening. As explained in our podcast before, when interest rate is expected to rise, investors will usually sell the bonds because when interest rates go up, new bonds come with a higher rate and provide more income, while the current bond becomes lesser in values. So investors will ultimately choose to sell the current bonds now. While on the other side of the world, China is still battling the COVID-19 and authorities in Shanghai have said they will actually tighten the enforcement of lockdown measures as cases continue to surge. New measures include placing electronic door alarms to prevent those infected from leaving, as well as evacuating people to disinfect their homes. The restrictions will take Shanghai's lockdown into its 5th week and keeping most of its 25 million residents trapped at home. Some in lockdown areas of the city have been struggling to access food supplies and forced to wait for government drop-offs of vegetables, meats, and eggs. The lockdown extensions has overwhelmed delivery services, grocery shop websites, and even the distribution of government supplies. Shanghai has implemented new restrictions by dividing the city into 3 zones: lockdown zone, control zone, and precautionary zone. Areas which have no new cases in a week will be marked as control, and if they reach 2 weeks with no new cases, they will be further downgraded to prevention. People in the zones with fewer or no cases will have more freedom, such as being allowed to move around within their housing compounds. Should the lockdown in Shanghai extend further, not only the Chinese economy but the world economy may suffer together because of the importance and significance level of Shanghai in world economy. First of all, Shanghai has the largest GDP of all Chinese cities, amounting to 4.32 trillion yuan. By the end of last year itself, more than 800 MNCs have established regional or country headquarters in Shanghai, including Apple, Qualcomm, General Motors, PepsiCo, and Tyson Foods. Shanghai is also the 3rd largest stock market globally by value of the companies. Trading activities continue despite the lockdown, but some banks and investment firms have been asking their staff to remain on site. And when I say on site, it means they are asked to sleep by their desks to keep the market functioning. Yeah, the situation is that bad because when the employee goes home, he or she might not be able to leave home anymore. So although some firms have restarted operation in Shanghai by having their employees on site, many companies continue to face the challenges of labor shortages and logistical difficulties. Due to all these challenges, nearly 30% of goods that were supposed to leave the port of Shanghai are being held up. The delays are set to escalate the supply chain crisis that has already caused shortages and price rises across the world. It only means that inflation will get worse in times to come. And China itself is not being spared from the situation. Beijing set its annual GDP growth last month at around 5.5%, but just last week the IMF slashed its forecast for China this year to only 4.4%, as China begins to feel the implication not only from the lockdowns but also the impacts from Russia's invasion of Ukraine. But there's still no signs that the Chinese government is prepared to ease restrictions soon, even though concern is piling about the economic damage they are causing to the world and the country itself. We have written a very detailed piece about China's zero-COVID policy and the impacts on our Facebook publishing. Do take a look if you are interested to find out more. So I guess that's the end for this episode. And with all those being said, it is quite apparent that currently we don't see any positive catalysts in the global scene. And when the global markets do not have positive momentum to offer, it is fairly difficult to lift our local market as well. But we do believe that commodities play will still be very well supported at the moment. Again, this week and coming week will be very important to the market with the release of corporate earnings and Federal decision next week. The market may pick its direction depending on the outcomes. So let's check in again next week. Together we grow in the stock market as well as our portfolio. Bye bye!